Up until World War I, the economy was driven by spontaneous forces of supply and demand. It doesn't work that way anymore. I'm Richard Duncan. In this course, I'll explain how the economy works now. Here's a quick overview of what's changed. In the past, the federal government played very little role in the economy. Now the government actively manages the economy to make sure that it continues to grow. Dollars used to be backed by gold. That ended in 1968. Now the central bank creates money from thin air and uses it to push up asset prices. During the 5 years since the global economic crisis began, the Federal Reserve has increased the size of its balance sheet from $900 billion to $3.5 trillion by creating fiat money. And over the same period, the government's budget deficits have exceeded $6 trillion. In 2008, the government effectively nationalized the mortgage market by putting Fannie Mae and Freddie Mac into conservatorship to prevent them from collapsing into bankruptcy. Before the breakdown of the Bretton Woods International Monetary System in 1971, trade between nations balanced. Since then, the U.S. current account deficit has ballooned and become the driver of global economic growth. It peaked at $800 billion, or $2 million a minute in 2006. When it corrected, the global economy went into crisis. Central banks outside the United States create their own fiat money and use it to buy the dollars entering into their countries so that their currencies won't appreciate and undermine their export-led growth. The equivalent of $9 trillion of fiat money has been created that way since the turn of the century. That amount dwarfs the $2.5 trillion created by the Fed in recent years. The creation of so much money played a leading role in producing the biggest global economic bubble in history. Globalization is very deflationary. By driving down wage rates in the developed countries, it's completely offset the very inflationary impact of rapid credit growth and fiat money creation. And the lack of inflation has allowed governments to borrow trillions of dollars to finance their budget deficits without pushing up interest rates. In fact, interest rates are near all-time lows. Total credit in the United States first exceeded $1 trillion in 1964. Since then, it's expanded 57-fold. Credit growth now drives economic growth. The question is, how long can this continue now that the private sector is so heavily in debt? In this course, we'll see how the economy really works now under these completely new circumstances.